The headlines are everywhere. The markets are a sea of red. Financial news anchors are calling it Black September, and they're not wrong. The S&P 500 has plummeted over 20% this month alone, marking the single worst September for stocks in a century. In times like these, your emotional brain, the part of you that is wired for survival, is screaming at you to run for cover, to sell everything, to get out before it gets worse. And that is why this may be the most important video you watch this year. Because I am here to tell you that while everyone else is panicking, the decisions you make in the next few days and weeks could define your financial future for the next decade. This is not a time for fear. This is a time for strategy. Crashes are not the risk in investing. They are the price of admission for long-term returns. More than that, they are the single greatest wealth creation opportunity the market ever gives us. And the biggest wealth destroyer is doing nothing. Today, I am giving you the investor's playbook for a market crash. We will cover the historical context, the psychological traps to avoid, and a step-by-step guide on how to not just survive, but to actually profit from this plunge. It is time to silence the panic and awaken the opportunist. Let's begin. First, let's put this chaos into context. Is this crash unprecedented? Yes and no. The speed and severity of this particular September plunge are historic. But the crash itself, it's perfectly normal. There's a well-documented phenomenon in market history called the September effect. Statistically, for over 100 years, September has been the worst performing month for the stock market. This year, the historical anomaly has been supercharged by a perfect storm. Central banks raising interest rates to fight inflation, geopolitical uncertainty with the war in Ukraine, energy insecurity with the European gas crisis, and slowing economic growth, which means reduced corporate profits. But let's zoom out. A market correction, which is a drop of 10 to 20%, happens on average once every 2 years. A bear market, which is a drop of 20% or more like the one we're in now, happens on average every 5 to 6 years. Since World War II, there have been 10 official bear markets. And what happened after every single one of them? The market recovered and went on to hit new all-time highs. The first step to profiting from a crash is to understand, deep in your bones, that this is normal. This is the sale that you've been waiting for. Now, what do you actually do? Here's your 4-step playbook. Step 1. Absolutely nothing. This is the hardest but most critical first step. Do not panic sell. I repeat, do not panic sell. When you sell in a downturn, you are taking a temporary, on-paper loss and making it a permanent, real-life loss. History is clear on this. Some of the market's best days happen in the middle of a bear market or immediately following a bottom. A Bank of America study showed that if you missed the 10 best days of the market in any given decade, your returns were cut by more than half. By selling, you are risking missing the powerful recovery. The second step, the financial triage. Before you even think about buying, you need to check your own foundation. Ask yourself the questions. First, is my emergency fund with 3 to 6 months of living expenses still fully funded and in cash? If not, any extra money you have should go there first. Second, is the money I have in the market money I won't need for at least the next 5 years? If the answer to both is yes, you have a green light to go on offense. Step 3. Prepare your buy list. This is where the profit is made. A crash is a sale. It's the stock market's Black Friday event. High-quality assets are now trading at a 20%, 30%, or even 40% discount. For most investors, the buy list should be simple and powerful. A low-cost, broad market index fund, an S&P 500 ETF like VOO, or a total stock market ETF like VTI. This is your opportunity to buy the entire U.S. economy on sale. You're not trying to be a hero picking individual stocks. You're systematically buying the best assets at a discounted price. Step 4. Execute with a system. Do not try to time the absolute bottom. It's a fool's errand. Instead, you deploy your capital systematically. If you are already investing automatically every week or month, do not stop. In fact, if you can, consider increasing your contribution. Your automatic investments are now buying significantly more shares for the same amount of money. This is the core of how you profit. If you have a lump sum of cash on the sidelines, you can systematically deploy it. A common strategy is to invest a portion of it now that the market is down 20%, perhaps another portion if it hits minus 25%, and so on. The key is to have a predetermined plan and execute it without emotion. Let's address the big fears. Question 1. How do we know this crash won't be different and the market will never recover? Because the long-term stock market is a reflection of human progress, innovation, and corporate earnings. As long as you believe that humanity will continue to innovate, that populations will grow, and that great companies will continue to create value, then you have to believe that the market will eventually recover. It always has. Question 2. Shouldn't I just wait in cash until things feel safer? The market will bottom long before the economy feels safe. By the time the headlines are positive and everyone is optimistic again, the recovery will have already happened and you will have missed the greatest opportunity. The time to buy is when there is maximum pessimism in the streets. Question 3. What if I am near retirement? This is the one group that needs to be more cautious. If you need this money in the next few years, you should already have a significant portion of your portfolio in less volatile assets like bonds and cash. A crash is a stark reminder of why asset allocation is so critical as you approach retirement. You shouldn't be panic selling your stocks, but you also shouldn't be aggressively buying if your time horizon is short. A crisis is a terrible thing to waste. This market crash, as painful as it feels, is an extraordinary opportunity for those with a plan and a long-term perspective. You now have that plan. You understand that this is a normal cycle. You know to avoid panic selling, to check your financial foundation, and to systematically buy high-quality assets at a discount. You can now operate from a position of logic, not fear. Your action item today is to make your plan concrete. Write down your buy list, even if it's just one index fund. Decide how much you can afford to invest and on what schedule. Turn your fear into a written, actionable strategy. If this guide has helped arm you with the confidence to navigate this downturn, please hit that like button. That's the best way to help this video reach other investors who are feeling scared and uncertain right now. And to continue getting rational, no hype financial guidance, make sure you are subscribed and have the notification bell on. We'll navigate this together. Finally, in the comments below, share one thing you are doing to stick to your long-term strategy during this crash. Let's build a community of disciplined, rational investors. Thank you for your time. Stay patient, stay invested.